Mr. Raman, is weaker than expected margins guidance, obviously for the current year, contributing to a bit of the disappointment that we have seen in the market in the immediate aftermath of the numbers being out?
Thank you for touching on that, because I think this deserves some explanation, because I don't think it is well understood. I think people saw us print for projects and manufacturing business an operating margin of 8.6% last year, FY23, and they saw that number decline to 8.2 in FY24, and this whole mood changed, saying that the profitability is dipping. What is missing everybody's attention is the revenues, the resources that we deployed to earn that 8.6% last year was almost 18-19% of the revenues. The resources that we deployed in FY24 to earn that 8.2% is 12% of the revenues. This is a significant conservation of revenues earned to generate that profitability. Secondly, the fact that 40% of our order book comes from international markets is also contributing to this new trajectory. In international markets, as I spoke a little earlier, a lot of focus is given on cash flows being pumped into the project early on and through the course. In India, the cash flows gets pumped into the projects towards the end of the project. So if you factor for time value of money, I might make 9%, let's say, on an Indian project, but I'll get my money, let's say, 18 to 24 months beyond time. And if I'm going to get, let's say, 8% margin in international projects, but I'm going to get the money upfront or well in time, I think the time value of money kicks in which is the reason why, despite the margin coming down from 8.6 to 8.2, the return on capital invested has gone up by 200 basis points and the ROE has gone up by 270 basis points. So the value creation has multiple levers. One lever is the absolute margin. The other lever is the resources that you deploy to earn that margin. And I think as a company, we are focused on creating value. The levers have their own dynamics and they will change depending on the type of order, size of order, geography, etc. So my suggestion to the markets would be not to unduly stress over an absolute number of 8.2 or 8.6, but see how the return on investment plays out. And from that perspective, I will take the 8.25, 8.5 range, given the 12-15% resource intensity, any day over a 9% or 9.25% with a 20% resource intensity.
One follow-up on this, and I'm looking at a ICICI Securities report, which says that core EBITDA margin guidance is muted owing to unfavorable mix of projects under execution. Now, would you want to explain what is perhaps being alluded to so that there is better clarity on this aspect of unfavorable mix of projects under execution?
See, in the previous years, when the margin post-COVID had declined, we had orders in our book which was exposed to commodity price. And as you will remember, the commodity prices shot through the roof. And no amount of mathematical calculation could have prepared us for that kind of swing that we had in the prices. So the company at one point in time had to execute projects which had unfavorable commodity prices featuring its cost lines. And that over time, as we completed executing those projects, have reduced. Today, the orders that we won in 20, 21, etc., are a very small percentage of the total order book. The order book that we have largely reflects the more recent orders. So the brokerages normally track about how much of remnants of the old orders that the company has. And a bit of commentary on that unfavorable mix could be that the last of those will also play out during FY25. So FY26, we could have possibly a relatively brand new order book. Secondly, the mix of domestic and international, as I told, in 21,
Yes.
22, etc., we had almost 20% international. Today, we are having 40%. Now, the mix does not mean unfavorable from an overall business perspective, but from the absolute number of margin movement, the mix does have an influence. As I mentioned, Middle Eastern margins are 1 to 2% lower in terms of margins as compared to Indian projects, but they more than make this up by making sure that the resources that are available to us is far more front-ended. So when we approach Middle East, we can't approach Middle East as am I making 8, 9, 10%? Am I making 10% in India? Am I interested in making 8% in Middle East? That's not the way to do. I'm making 10% on water resource base and making 8% on water resource base. And so long as the mix is favorable, I think the business mix of higher international does not hurt the overall value creation. But sometimes I think patience to understand these levers is short from a market perspective because they do go by the top line and form immediate reaction. So to that extent, I think it has caused some volatility. But as people begin to understand the details, I'm sure I think their confidence on the stock will return.